Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. You know, investing in alternative investments has become really mainstream lately as innovation has made the asset class more accessible for investors. But, I personally think more can be done to increase awareness and education. Well, I'm very excited about our next guest, who is an industry expert and is here to share his insights into the world of alternatives. But first, today's episode is sponsored by the award winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I am honored and excited to welcome Marty Gross. Marty is the founder and president of Sandalwood Securities. Marty, thank you so much for coming on the show. It's really an honor to have you on. Thank you. Can you please start by just telling us a little bit more about yourself and Sandalwood Securities?
Sure. Sandalwood Securities was formed in 1990.
Yeah.
It was one of the earlier fund of hedge fund businesses that existed at Wall Street. The thesis at the time was that there was value in finding, analyzing, helping investors afford and monitor the great hedge fund managers at the time. In those days, there were not many databases. And so it took a lot of legwork to actually find hedge fund managers before you could even analyze them and decide if you wanted to use them. It was also a very interesting time because in the late 1980s through the 1990s, this was a formative period for many of the managers that turned out to be the great hedge fund names that we still hear about today. That business generated significant dollars over the years. And the dollars from that business has allowed us to create our own family office. So what does that mean? It basically means that our family has an institutional portfolio with 8 different categories of investments. They are bonds, stocks, hedge funds, real estate funds, individual real estate properties, venture capital, private equity, and lending.
Okay.
And over the last 6 to 10 years, as the family has been making investments in those categories, we've expanded those offerings to clients on a co-investment basis. The way that works is when the family makes an investment in one of those categories, we create an SPV for each particular investment, show that to those clients that have expressed an interest in that particular category, and they then invest side by side with us in that SPV into the underlying fund. This enables our investors to build their portfolios out one at a time in conjunction with the way Sandalwood builds out their portfolio. And
Fantastic.
so we have essentially evolved into what we refer to as a family office-driven alternatives platform.
Okay. Fantastic. So would you say then a lot of your clients are more financial advisors that are co-investing with you, or is it other family offices?
It's a combination of high net worth investors,
Okay.
registered financial advisors who use us to create platform investments for their clients, family offices, and some universities and foundations and endowments.
Fantastic. You started, like you said, in the 90s, 1990, and you're exactly right. Back then, finding data on hedge funds, it's probably impossible, really. So, it was such a great business opportunity. But I still would think, even though with data being so much more prevalent in applications and data platforms, still finding good, clean data on hedge funds can still be somewhat difficult, I'm assuming.
The data is reasonably available.
Okay.
The challenge is that if you go on the web, you read that there's over 8,500 different hedge funds with, I believe I read, $1 trillion in assets.
Okay.
So there's a huge number of hedge funds. The challenge is sifting through them. It's also the case that a very small percentage of the hedge funds has a very significant percentage of the capital in the hedge fund space. So it's not evenly allocated across the hedge funds. It's very, very lumpy.
Mhm. Interesting. I feel as if that could be a whole conversation by itself, Marty, is just talking about, what do you look for when you invest in hedge funds? Because I think for some financial, and that's probably why they would just go to you, Marty, and Sandalwood and be like, I'm going investing with you guys because I'm not about to try and do due diligence on my own for the hedge fund space.
Yeah, it's very complicated because, you know, as I said, we've expanded beyond the hedge fund space into the general alternatives class. Okay. So what do we mean by alternative? Alternative investment generally referred to an investment whose return stream was reasonably uncorrelated to that of the equity, right? So alternative, the word alternative basically meant something other than long equity. Okay. So hedge funds kicked in as alternatives because they would be something other than long equity. Okay.
Mm-hmm.
So then the question is, so what would they be? Right. So you had hedge funds that would only invest in credit. You had hedge funds that would invest in long equity, but also have short positions. You would have hedge funds that invested in activist situations or event situations like
Mm-hmm.
bankruptcy. You had hedge funds that were trading operations. You had hedge funds that were basically macro investors. You had hedge funds that were short only. Okay. You had hedge funds that did convertible arbitrage or structured credit. So there were many, many different sub strategies within the label of hedge fund.
Mm-hmm.
So when we look for hedge funds, the first criteria we looked for was what type of strategy do we want to invest in? Because let's say we wanted to invest in distressed debt. In that case, we're not looking at macro hedge funds or trading hedge funds. We're only looking at a subset. So the
Mm-hmm.
problem was pick your strategy, and then you can decide which types of hedge funds to look for. But alternatives really, it's a much wider band than just hedge funds because, as I said, it does include lending and it does include venture and private equity and real estate. So right now, when we say alternative, we really include all of those categories that institutional investors access in addition to the hedge fund space.
Mm-hmm. I'm really glad you brought up that alternative space. It is so broad today. There's so many different sub asset classes of alternatives. When I started in the industry and aged myself at some 20 years ago, in creating client portfolios, it usually consisted of REITs or maybe a commodity mutual fund. And then at that time, the long short funds were getting popular, but those were alternatives. And like you said, it was to help diversify a portfolio. Now there are a lot more options, like you mentioned a couple of them. What are some other options or examples of alternatives that maybe retail investors can get more exposure to now than they did 20 years ago?
Well, we're seeing a lot of what are called liquid alts,
Mm.
where we're very skeptical about that. In
Okay.
general, you really need to match the liquidity of a fund with the underlying nature of the assets. So we've tended to significantly shy away from liquid alts. We,
Interesting. Okay.
um, it is now possible through us or others for retail investors to access private equity, venture, especially lending funds, where people can have a very reasonably predictable expectation of what they will be getting every year or every quarter from their lending fund. And that's very, very helpful for older investors who are
Mhm.
looking for their portfolios to generate current income on which to live. So that's one of the ways in which financial advisors use alternatives to meet the financial needs of their
Mhm.
clients. One thing it's important to think about is that when you make an investment, you're basically adopting an investment thesis. Like, why am I doing it? Okay. So, for example, if you invest, to put it simply, in a money fund, the investment thesis is simply to make whatever interest rates you make on a money fund, right?
Yeah.
If you invest in public equities, you have an expectation over very long time frames of approximately a 10% return pre tax and inclusive of dividends, because that's the very, very long-term return from public equities. We'll say the S&P 500. Some decades you get more, and some decades you get less. And there have been decades where that have been flat for the entire decade, starting, right after the financial crash in 2008. The thing to bear in mind is that whenever you invest in an asset category, you need to have a return expectation. So I said the long-term return expectation for public equities is 10 based on close to a century worth of numbers. If you're going to invest in private equity and be illiquid for a significant period of time, you need a premium to that. So normally the return target for private equity is 15. That's similar to real estate, and for venture capital, you'd add another 5% given the risk. So if you're making a 12% return on venture capital, you're probably making 8% less than you should be making. The category that's generating a lot of interest today is lending funds. Now, why is that? When interest rates were zero or near zero, it wasn't a very interesting place to be. But if today you can generate between, let's say, 8 and 12 to 15% in lending funds without taking significant risk, that's very compelling because you're making the long-term return of equities by being a lender. So we're seeing a significant amount of dollars coming into lending funds. Okay. If I could just say a few more things about lending funds, I think it might be helpful. When we look at lending funds, there's a couple of basic questions we ask. The first is, what's the collateral? Am I lending against real estate, or am I lending against, shall we say, corporate assets? Mm-hmm. Another question we ask is, am I in the first position? Am I the senior secured, or am I the mezz? There are lending funds that can be very risky because they could be loan to own or hard money lending. Yeah. And there are lending funds we view as, shall we say, very low drama because we're not using much leverage and we're not, the loan to value is very low. In many lending funds, you're not taking interest rate risk because the loans are floating rate. In some lending funds, you also get warrants. One thing to be careful of in lending fund are the fees, because you just have to be careful if you're paying a management fee. What are you paying? What are you paying it on? Are you paying it on your capital, or are you paying it on your pro rata share of the leverage? So we look at the lending funds from a structural perspective. They're also very interesting because in many cases, when you put up the capital, you're getting quarterly distributions. And you have 4 quarterly distributions a year, and you can know exactly what you're making from the lending fund. Other lending funds also come with favorable tax benefits because they can be distributions, be treated as distributions from a REIT, which means you're at the 29% federal tax bracket. So lending funds is an area where there's been a lot of interest recently. In fact, in some areas like the corporate area, you're starting to see substantial amounts of capital coming into the space. You're seeing returns dropping a bit because there's a huge demand to put out money. And so people are accepting less in the way of interest payments. And in some cases, you're seeing weakening of the covenants on the loans. So one has to be very careful when doing a lending fund to understand all of these different factors. Mm-hmm. But you're starting to see a lot more. And when you look at, shall we say, private equity and venture funds, mm-hmm. you have to distinguish between the larger funds and the smaller funds. You have to distinguish between funds that are general or funds that have specific themes. We've recently done a fund that's just in the supply chain. We've done a fund that's in later stage healthcare, where money comes in as structured finance, where there are funds that do litigation financing, yep. Right? So there's many, many different types of funds out there. When you get to the real estate sector, there's a lot of very interesting real estate funds. You have to distinguish between funds that, for example, will just do multifamily or will just do industrial, mm-hmm. or might do storage or retail or office, where it's one asset type. And yet there are many other funds that do many, many different mm-hmm. types of assets. The other interesting wrinkle in real estate funds are funds where you own a percentage of the general partner.
Okay.
So your interest in the fund, what you make on your capital, is enhanced by the fact that you own a percentage of the general partner's carry. So it's a very robust, diverse area. But we've found that when you delve into it in all these different areas, there's a lot of really good rewards that you can achieve if you do the work.
Right, right. And like you said, you got to do the work, know what you're investing in, right? Because this alternative space is expanding by the day. You know, like you talk about real estate, there's so many different types of real estate. Now you got the data centers, which are so popular. A lot of things to consider there. I'm really glad you brought up expectations, right? And you mentioned like return expectations. What should be the return expectations? But and you mentioned there's always that risk premium that, when you, especially when you're considering illiquid investments, what type of premium do you add on to those return expectations? Can you talk maybe a little bit more about the different risk expectations? Yes, there's obviously liquidity. What are some other risk expectations that investors or financial advisors should look to get premiums on?
Yeah. That's a gigantic topic. Um, there-
Another episode?
sure. There's so many types of risks. There's manager personal risks. There's operational risks.
Okay.
There's macro risks.
Yeah.
Uh, there's execution risks in the lending space. There's a risk of after you fund your partnership, there's too much capital coming into the space. Um, Generally speaking, a lot of that is knowable beforehand, but some of it's not. Okay. So, for example, I'll give you an example of a risk people really didn't talk about much until a year or two ago. And that is that in general, if you do a private equity or venture fund, you're thinking about, let's say, a 4 and a 5 year investment period and then a 4 to 5 year harvest period, give or take, right? Um, After there was a significant increase in interest rates, that hurt the valuation of many companies. So there was a significant slowdown in exits. So many people had made capital commitments for funds, expecting that they would get exits from their existing funds, and that slowed down. So, shall we say, a reduction in distributions from funds turned out to be a much more significant risk than people had given enough weight to. Um, if you are having overseas investments, there's always political risk. Um, I can think of so many cases that we've heard about where people were investing in other countries and ended up having situations they didn't contemplate. And they ended up being about political risk.
Okay.
So those are some of the main, macro types of risks. There's always the risk of the market being flat for extended periods of time and things of that sort. And there's always geopolitical risk.
Yeah. Yeah. Like you said, that wall of risk, it seems like it's getting bigger by the month. And it's just, and I think, you make a good point. It's like when you're diversification portfolio, creating an investment portfolio 101, it's about trying to diversify and hedge some of those risks, right? And that's why you would invest in alternatives, is
Right.
to hedge some risks that maybe are in the equity markets or the fixed income markets. Um, so I think that goes into the next question I have. Why should financial advisors include alternatives in an investment portfolio, and what role do they play?
Sure. Well, putting a portfolio together is um, the way in which you achieve the goals you set for your dollars, for your capital.
Mhm.
So people come to their money with different agendas. So, for example, you're much older, you've already made enough money, you need your portfolio to generate more than enough money to live on, right? So that portfolio might have very little in the way of growth, right? And it might have a lot in the way of lending funds. We see a lot more older people picking lending funds. So alternatives are basically different tools in a toolbox to build different types of portfolios. And each type of portfolio is really reflective of the different needs of a particular client. So they simply create more tools for advisors to achieve different return profiles. So, for example, let's assume the stock market is wildly overvalued, right? But let's assume that's not the case for early stage companies in different areas. So, in that case, venture gives you a chance to go into companies at much earlier stages without worrying about equity market valuations. They're basically different tools in a toolbox to help
Mhm.
you build a portfolio, um, which, for example, could significantly reduce volatility. So let's say you have 25% of your money in lending funds, just to pick an example, right? That 25% is rarely marked down unless there's a real problem with the loans. So in times of significant volatility, that's going to be an anchor and ballast to your portfolio. So by virtue of blending different strategies which don't correlate with each other into a portfolio, you're able to not necessarily compromise returns, but significantly increase the risk-adjusted returns of your portfolio.
Yep. Yep. Fantastic. I love it when people bring up risk adjusted returns because that's the name of the podcast, Adjusted for Risk. It's a take on that. So it's fantastic. You know, we're talking about you're perfect talking about building a portfolio, investment portfolio and diversification and trying to reduce the risk. It's perfect for this segue. And I know this is a question that most people are going to answer. Well, it depends on the client, their risk tolerance, how old they are, and so on. But how much should a financial advisor consider allocating to alternatives? Is there kind of like a range? And I know it's a tough question to answer, but I feel as if right now we're not enough. That 60-40 portfolio that everyone talks about is dead. Maybe it's not necessarily dead, but it's just not, it should be 50-40-10 or something like that where you include alternatives. But
Sure.
what is that alternative sleeve?
Yeah, it's a great question. If you looked at how institutional allocators allocated their portfolios,
Mhm.
you could easily see 60 to 80% of the dollars in non-long only assets.
Wow. Okay.
So it really varies. We have clients that have maybe 60, 70, 80% of their dollars in alternatives broadly. We have other clients that have maybe 10 or 15%. The more lending funds you see people using, the higher the percentage of the portfolio that's allocated to various alternatives. It's a wide band. It really depends upon the um, um, the goals of the clients and the risk tolerance of the clients. Risk is a funny thing. Risk and volatility are not the same thing.
Yeah.
Warren Buffett would say that you want a lot of volatility so you can buy stuff cheap. And he would say that value is uh, price is what you pay and value is what you get,
Mm-hmm.
right? And he would welcome a lot of downside volatility so we could
Yeah.
buy good companies cheaper. Risk is really the possibility of permanent capital loss. Volatility is basically daily price movements. The main way not to go bankrupt is to not use leverage
Mm-hmm.
and to have a materially diversified portfolio. And if you do that, you're virtually assured to always live to fight another day. And when you look at the correlations of real estate and private equity to public equities, you can see that you can significantly, through the use of alternatives, not compromise portfolio returns, but significantly reduce portfolio risk and portfolio volatility.
Marty, I am so glad you brought that up because I've been kind of beating on that drum for a while now, done research on it. Volatility isn't such a bad thing. And if I'm a younger investor, that upside volatility, give me all that upside volatility I can take, right? If I get a 30% return in a given year, fine. But the real risk is me losing money, right? That's the
That's
risk of investing. Um,
right.
so I'm really glad you brought that up. Volatility, it can be a benefit, whereas risk, I think we need to reevaluate what is
Right.
the real risk of a portfolio, and it's losing money.
Right. Well, it's very difficult to, like I say, lose all your money if you're significantly diversified in reasonably good strategies with good managers and you're not using leverage.
Mm-hmm.
That's
Mm-hmm.
what kills. You can have a a very nice portfolio, sometimes for decades. And if you have too much leverage at the wrong time, in weeks, what you've built in decades can disappear.
Yeah.
You have to be very, very careful to avoid those extreme moments, which do happen in markets, to make sure you can survive it. And in almost all cases, it's leverage, which is what's destroyed people. Too much leverage is what's destroyed portfolios.
Fantastic. Great insight, Marty. Let's finish. So you mentioned at the beginning about Sandalwood Securities and co-investing. Let's take a step back here and talk about that. Your family office blends your investments with others, hence co-investing. What are some of the benefits of co-investing?
Well, the reason that someone should invest with us is if they look at the deals we're doing, the investments we're making, and if their assessment is if those investments are very, very high quality. So by paying us our fees, you're essentially sharing in the research operation.
Mhm.
You're only paying us fees if you actually use the program. And given the fact that we have one SPV for every particular fund we do, investors can cherry pick on an a la carte basis which particular asset categories they want to invest in and which particular managers they want to invest in, knowing that our dollars are going to be in the same SPV as their dollars.
Mhm.
At the end of the day, we're eating the same cooking that we're serving up to our clients.
Mhm.
There's a complete alignment of dollars into different investments. And so we're really, for many advisors, a research organization
Okay.
that is additive to their own operations, because they're not just they're getting the benefit of all of our insights over time, as well as the ones they would create for themselves. And the way we demonstrate that to people is to take individuals through the portfolio, one deal at a time, explain to them why we're doing it, what the results have been, and then people can judge for themselves.
Fantastic. You brought up a couple of good things. Personally, cherry picking, right? Right now, personalizing your investments to each individual or each individual family is so important right now. Everyone's values and what they believe in is different. So being able to customize that is important, because you can't get that with a mutual fund, right?
Yeah.
And then also just, investing in what you believe in, right? Again, you may not get that with the mutual fund. The mutual fund portfolio manager might be investing in something different of their own money, right? So, very good points there.
The alternative space is known for having the manager's money next to yours.
Okay.
That's one of the main things. They're not highly commoditized retail products. They're
Mm-hmm.
really the more sophisticated institutional products that are put together from a, shall we say, a non-retail perspective. If you just look at who goes into them and what the investment sizes are. The other benefit is that, by coming in with us, we might put $10 million into one of our SPVs,
Mm-hmm.
and investor might invest 1 million of that 10 million, just to pick an example, or more or
Yeah.
less. And we will have better terms from the manager because we're giving the manager 10 million. And so an investor with a $1 million investment gets the terms that benefit those with $10 million investments. So that happens also very frequently.
Perfect. Marty, such a great conversation. Thank you so much for sharing such great insight about, an area. You brought up some very good points about alternatives, right? And breaking it down to different talking points that maybe we don't hear enough about. So great job, Marty. I really appreciate it. It's been an honor to have you on. Where can our audience get more information about Sandalwood Securities?
Well, one last point. We also, in working with financial advisors, put together separately managed accounts for those advisors. Anyone looking for more information can go to our website, Sandalwood Securities. They can contact Rick Stockton, our director of IR, right off the website. So that's where we are to be found. And we really appreciate your time.
Yes. Thank you. Thank you so much, Marty. And thank you so much to everyone out there for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel. And lastly, please give us a follow on the Zephyr LinkedIn page to learn more about Zephyr. Thank you very much and have a great rest of your week.